Welcome, everybody. We'll be getting started here momentarily. Just sit tight. We want to give everybody plenty of time to get in the room. We have people pouring in at the moment. So just give us another minute or so. We'll kick it off. All right, let's go ahead and get started. Welcome, everybody. Once again, great to have you guys here. This is Jeff. We have a great workshop tonight. Compliments of AJ Brown. He's going to be sharing some of his top tips and tricks for leveraging option premium selling strategies. So get your pen and paper handy. He's got a lot of great stuff to share tonight. So without further ado, AJ, I'm going to go ahead and pass it over to you. You've got the floor.
Nice. Let me go ahead and see if my camera. Hey, everybody. This is AJ Brown, and I am with a company that I created back in 2003 called Trading Trainer. And as you can see on your screen, I've got a little presentation. Don't worry. My presentation is not all slides. I've got some actual trades I'm going to go through, but I also want to clear up two things. First of all, tonight's presentation that I'm doing is for educational purposes only, right? I don't want you to construe anything I'm saying as actual recommendations or trading advice. Of course, we're in the world of education here, but I do want you to pick up on all the good tidbits and definitely, like Jeff said, I'd love for you to take some notes. Folks usually say with the speed that I talk that they get about 4 or 5 pages of notes. So get a pencil or a pen if you're feeling confident, or if you're taking electronic notes, get ready to go. And also just pay attention to some of the insights, because I might do things a little differently, and it's good to learn from different perspectives, right? And my presentation is more, I'm not, there is something at the end I'm going to talk to you about, but for the most part, it's all education. I'm not really a person who's good at doing, a pitch for anything. So just kind of tune in and see what you can learn is my big thing. The second thing I wanted to address is this big thing on my nose, right? I totally was showing my 2.5, actually she's 2 months and 2 and 9 months. She was born on October 31st. She was born on Halloween. So she's 2 and 9 months today, one day after. And I was showing her something off of the diving board in a pool in our backyard, and I totally creamed at the bottom of the pool. And it's a good thing I have this Italian nose, because it kept the rest of my grill from getting scuffed up. But so just ignore this thing. It's just a little bit of a shot to my ego. I guess I'm a better investor and active trader than I am a diving board diver. That's why I'm not in Paris right now. So with that said, the name of my presentation is Your Guide to Escape the Pitfalls of Trading by Leveraging Options Premium Selling. And that's what really I've been doing for all these years. I do have in my programs a program for full-time options traders, but my biggest program is folks who just like to sell premium. So without further ado, let me get right into some of the things. And just know I like to ramp up very quickly. So if you get kind of thinking that things are going slow in the beginning, just hold on, okay? And humor me with some of my stuff, because I know based on, my discussions with Jeff and how Jeff has been on my podcast and talked to some of our peeps, I know you guys know a lot, but maybe, you'll see something different. Here we go. First of all, there's some facts going on right now. Lots of uncertainty happening in the world, right? There's lots of skirmishes in the world. There's, I don't know what's happening with our trade partners in Asia. We've got crazy 180 flips in our own politicking. Who knows what's going on with interest rates? Lots of uncertainty right now. But, when it comes to the markets, there's some tried and true rules. And if you play the markets right, you're going to be set up for months, if not years to come. And the key is is remembering that despite what all the talking heads will go on the news and tell you that, so many millions and trillions of dollars of people's 401ks disintegrated today. The truth is, the market's money doesn't disappear in the markets. Money simply transfers from one person's hands to the other. It's not destroyed, it's not created. It goes just from one person's hand to another. And so my big understanding and key for all these years, I've been doing this since 1997. I became a full-time options trader in 2005, is that you just have to put yourself on the correct side of the equation, right? Correct side of the transaction. So before I get started, and the chat box is open, I can see both the chat box. Actually, let me make sure I've got the chat box open. I also have the Q&A area. So you're welcome to type in either one. I think I have access to both. Yeah, I do. I do. What would be ideal for you? Because I can kind of tune my presentation today in a different way. So maybe you're somebody who likes to learn how to invest and your goal is low risk, high return, but you want to be 100% self-reliant. You basically want to learn how to fish and go off and fish. Maybe you're somebody who likes to learn how to invest, but you also like to have seasoned investors around you looking over your shoulder and kind of giving you the, is that okay before you go and make it? In other words, the analogy I use is you like to learn how to fish, but you like to be around expert fishermen so that they can kind of guide you and be there to help when you have questions. Or last, there is always a group of folks that basically they want to just do what seasoned investors are doing in their portfolio. They like to look over the shoulder of folks and follow what they're doing. I say fish alongside expert fishermen and do what they do. Or maybe I didn't sum you up in one of those three categories. Maybe it's something else. So if you can, um, um, if you can, go with that, let me know. All right. Yeah. Okay. I'm seeing different answers coming in. Some of them, a lot of them are saying, I want to be a fisherman, but some of them say, I just want to follow along. So here, let me kind of tune it a little bit. We'll see how this goes. Okay. You've seen this a million times. I know you have, but humor me here. What would you do? $50,000 today if I was going to give you a big sack of cash, or would you take that penny that doubles every day for a month? Now, I'm going to add some nuances there. If you take that penny thing, it's not going to double on its own. You're going to have to put in effort to learn how to make it double, and then you're going to have to stick to it and not get distracted by different shiny objects, right? And that's the key, isn't it? All right. We know what $50,000 in cash would be like, but let's go through the penny. So if I did take the time, figure out how to double this thing, and I put in the effort, I put in the time, I put in the understanding, I put in, you know, being able to deal with the ups and downs, because it's not always doubling the penny. Sometimes it's, you get the picture. So day 1, day 2, day 3, day 4, day 5, day 6, day 7, the first week of the month, let's assume that a month is about 4 weeks. You've got a whopping 64 cents to your name. You've put in a lot of effort to learn how to double your penny. You've had to stick with it. You had to be consistent. Sometimes you've had to, like, stay up in the evening when other people are asleep to get your studies in, make sure you understand what the heck's going on. And you're wondering, did I make the right decision? Because $50,000 looks really good compared to 64 cents combined with all that effort you put in. But then let's go day 8, day 9, day 10. Okay, we're about a third of the way through the month and $5.12. Now I'm really questioning whether or not I did right by that $50,000. So let's just stick with it here. Let's stick with it here. Let's go on to about 2 weeks. So 2 weeks into it, about halfway, actually halfway would be 15 days, right? $163.84. Man, $50,000, you're still wondering because, by now you've really had to stick to this. You've had to, through ups and downs, keep consistent, keep disciplined, and it still doesn't compared to $50,000. You're wondering, did I invest my time? Did I invest my efforts appropriately? All right, we're getting up to about 3 weeks. The month is all about 75% over. Now it's starting to look good, right? You've got 10,000, almost 10,500 bucks. Still not as much as the 50,000. Let's keep going. All right, so day 24, we find now put that into perspective. I've had to stay disciplined and stick with this, invest in a lot of stuff up front in the form of, getting things straight, hiring, teachers, following people, whatever I had to do. And I'm almost done with the time period that I was given, and I'm just now getting the results. In the beginning, it would have been so easy for me to give up, but if I stick with it, you can see in the last week of the month, I walk away with, you know, just just under $21.5 million. So now the clear winner, but and I'm not sure if Albert Einstein actually said this, but a lot of people attribute it to him. So compound interest, which is what we just demonstrated, most powerful force in the universe. Now, I'm not saying you're going to be doubling your money every day. In fact, what my folks and I aim for is to actually double your money every year, right? So I'll be talking about that. But the key is I want you to kind of look at this graph, this chart I've put on the screen for you, because I'm going to come back. I actually have a trade that mirrors this, but I want to talk about some of the highlights of this. First of all, you might notice over here that there's kind of a line here. This is the break-even line. And I've got two lines here. One's labeled range high, one's labeled range low. Couple of the key points is this is not a straight line, is it? This is a parabolic or a curvy line, right? An exponential line. And the other thing is range high or range low. Range low actually gets above my break-even line, whatever these increments are on the x-axis, very early on, and then goes from there. We'll come back and really dissect this a little bit further, but I just want to kind of, plant a little seed or wet your palate on this, because we're going to be talking about these type of gains and trades in a little bit. So here's what I learned early on, and I'll let you know that I didn't quit my full-time job and become a full-time investor until I was 8 years into my journey of doing trading, right? In fact, I started Trading Trainer, the education company, 2 years before I even quit my job at Hewlett Packard. I was a mid to high level executive at Hewlett Packard. And I quit in 2005, and I've been living off of my trading ever since. But before then, I had 8 years of accruing profits in my portfolio before I even thought of taking out like a dividend from that portfolio to live on. And I recommend that to a lot of my program participants. Don't start stealing from the golden goose until the golden goose is producing so many golden eggs that it wouldn't miss one. I don't know if that analogy plays through, but here's what I did. I reversed engineered doubling my money every year, and I realized that if I just focus on 6%, if I focus on a 6% growth every month, then my portfolio more than doubles every year. Now that's what I focus on. The truth is on our trades, we're typically with our premium selling looking at double digit, like low 10, 11, 12% ROI. And so what's really nice about that is we're actually the folks in my coaching program, we're actually doubling our portfolio more like in every 4 to 5, 6 months than every year. But our focus is our worst case scenario is can we double our portfolio every year? Because if we did, right, you start with $1,000 portfolio. And if you're selling premium, that is a viable starting point. I had somebody start as low as 800 bucks. The truth is around 5,000. That's when it really gets to where you don't have to limit your choices on underlying symbols. You probably know this already. I'm probably preaching to the choir here. But say you start with your portfolio at $1,000. That means if you focus on those 6%, then in 12 months, you got 2,000, right? And in 2 years, you got 4,000. And in 5 years, you got close to 33,000. And in 10 years, you're a bona fide millionaire. And this is actually the exact equation I followed. I started this in my late 20s. And now I'm 51 years old, and my portfolio is quite large, right? And I've just been parlaying it. The other cool thing about, well, let me just say one other thing. When I was a kid in the 1970s watching shows like Chips and Love Boat and stuff, they would mention a millionaire and you'd be like, wow, millionaire. And these days, the millionaires are a dime a dozen. What you really need to be in order to separate yourself from the pack is a 10 millionaire, right? So keep that in mind when it comes to parlaying your portfolio. But one of the cool things I like about focusing on the numbers this way is that if you grow your portfolio to about $100,000, right? Or if you have a $100,000 portfolio, you could generate over $100,000 per year. The median salary for a white collar job, that's where you work 60 hours per week, right? Right now is $87,000 in the United States. Now, that doesn't count you folks on the left and the right coast. You guys have a much I'm here in the Washington, D.C. area right now, and that $87,000 wouldn't buy you diddly. But if you look at the whole United States, it's 87,000. In this case, right, you grow your portfolio to this certain critical mass number, and then you can start generating more than you need in order to live. And you're not having to put in that $60,000. I think I told you guys on the podcast on Tuesday, my big goal, right? I have a toddler, I know. 51 years old. What are you doing with a 2-year and 9-month-old? Long story. It's not actually that long. It was quite quick. But anyway, the point is I want to spend as much time with her as I can, right? And so and I've always had something that I wanted to spend passions that I wanted to spend time on. Even before my daughter came around, I had other things that I wanted to focus on. So when it came to focusing on, my portfolio and my investing and my trading, I needed something I could do end of day, right? There was no way I could be a day trader. So that was never even in my vernacular. In fact, I tried. I even tried things like Forex, where you have to be up in the middle of the night to trade your currencies between like midnight and 1 and stuff, and commodities. But the thing that really resonated with me is options, equity options, options on indexes, ETFs, and stocks, right? And so those type of investments, what I like about options is they give you a lot of choice. And it really comes down to looking at for patterns, and it doesn't necessarily have to be price patterns. It could be patterns in all the different variables that influence an options price. Find the most reliable and predictable pattern and then trade it accordingly, right? So what am I talking about today? What are we actually investing in? So for the nerds out there, we're talking about selling theta decay optimized option premium, right? And for the rest of us, that was a lot of word salad. So brought down to normal person speak, we're profiting on time passing by, right? So a lot of folks, when they think about options investing, they're thinking about leveraging underlying symbol moves, right? Because that's like a quick way. If you can identify an underlying symbol move and then use a leveraged option, it's a quick way to a reward. Of course, you're opening yourself up to a quick, large amount of risk as well by doing that. So what's a more reliable variable? Well, time passing by, right? Because I don't know about you, but if 60 seconds all of a sudden didn't equal a minute, or 60 minutes didn't equal an hour, or 24 hours didn't equal a day, or 52 weeks didn't equal a year, I think we'd be worrying about something more important than even our portfolio growth, right? The world would be coming to an end. So time passing by is a very consistent variable, and guess what? If you pick your option right, it can really be, you've seen the time decay curve. Well, that's what we're talking about. So first of all, I'm going to stop talking and I'm going to ask you a question just to make sure you were paying attention. What minimum returns did I say we have to focus on monthly on our portfolio if we're going to be doubling our portfolio annually? What's our number? Is it 0.5%, 1.5%, 5, 6, or 10? What'd you guys pick up? Yeah, I see people typing in D6. You're absolutely right. If you didn't get that number, just write that down in your notes because that is what I said. And I do tend to tell a lot of stories and talk a little fast, so I understand. But 6% is the focus of our goal, 6% per month. But now you guys know this already because I know a lot of you are trading these options, but aren't these things risky? And I think the answer to that is opposite, right? In fact, options were created in order to hedge risk, right? But the scoop is, in my mind, like if you're trading stocks or commodities, you pretty much can make money in one way, right? By buying it low and then selling it high. It's called going long, and it's one strategy, right? One way, and you have to time it just right. If you're, you have a margin account, you're able to do, you can short, right? You could sell to open and then buy to close. And so you make money if the underlying symbol price is going down. So you have maybe two strategies in your wheelhouse. But with options, of course, you've got plenty of strategies if the thing goes sideways, which if you look at the overall symbols, there's always a lot of symbols going sideways, right? Time passing by, my favorite variable. You can even make money because options are influenced by whether there's fear or whether there's confidence in the market, right? So options, I don't mean to keep pushing how cool they are, but they really are. And they get a bad rap because a lot of people have used them wrong, but I'm way into them. So there you go. And so let's review what these things are just really quick. Financial instrument called a derivative, typically bought and sold by the market movers in order to hedge risk against our stocks, indexes, ETFs. And what we're doing is instead focusing on selling their premium to generate an ongoing income, right? Now, before I go any further about this whole selling premium concept, let me just ask, and I'll ask you to be honest. Have you heard me? Because I've got about 3 or 4 slides that introduce you to me. I've been around for, somebody told me you've been around since hammer was a hatchet. Um, if you know who I am, I'll just skip these slides. If you don't, I'll take a minute and introduce myself. So let me know if you know who I am with either a yes or no, or I know who you are, or anything like that. Let me go through a couple of these. Uh, um, So first of all, I got all these places that the team here at Trading Trainer has put out me there. So maybe you want to jot down some of these quick links here. I've got a YouTube show. You can go and see Jeff on my show. He was on a couple weeks ago. Podcasts. I've got a Facebook profile. They don't call it Twitter anymore. They call it X. I've written a heck ton of articles about trading over the years, as well as white papers. So if you really want to nerd out on different types of premium selling or things like that, you can read my white papers. If you're interested in just shooting the breeze, you can either contact us and I'll get a hold of you by email, or if you want to call me, there's my phone number. And if you do go to any of those social media profiles, do me a favor and hit that subscribe button because, of course, that makes the algorithm work best for everybody. Another thing, though, is I founded this company called Trading Trainer. Um, I've been introduced as like somebody who's the most disciplined options trader in the past. I think, and that's from my peers. I actually think they think I'm the laziest options trader. I like to think of myself as the most efficient options trader. It's because I like to do as few moves as possible. For me, it's not about the journey. It's about the destination. It's about getting every third Friday of the month some income into my portfolio and parlaying that portfolio, and then having a lot of time outside of this to do other things, right? I have a charity I started quite a while ago. I've got my little one that I keep talking about. I've got plenty of extracurricular activities, none of them do really, really well at making money. So I just need this thing to work and keep my lifestyle up and running. So I try to minimize my time as an active investor, but at the same time, keep the ATM machine rolling. I've been doing this since 1997. I've been publishing my insights to my participants every night, 5 days a week since 2002. There's an ebook that I published in 2005 that I keep finding on people who are successful options traders. I'll find it on their computer when I'm just hanging out with them. 2008, I put out this huge home study course that I find on people's shelves. But the real thing is in 1997, I had, I was working at Hewlett Packard. I've got a degree in mechanical and electrical engineering. I've got a master's degree in automatic controls, blah, blah, blah. I never really used any of them. I went right into marketing when I got into the corporate world. I've got a strong background in commercial business and investing. And in the last 12 years, I've really focused on how to be a good teacher, right? I've been a student or practitioner of this method called accelerated learning methods, which is really all about how to teach folks that are not in school anymore, that have less plastic heads like mine. Like I'm really stubborn and I don't like to learn new things, how to get through and get them to pick up new skills, right? So that's really my CV, if you will. But the big thing is when I started in 1997, man, I lost big, and it was a good thing that I had a very good job, and I was living in Silicon Valley with a whole bunch of guys, so I was hardly paying any rent. I didn't have a family. I didn't have a mortgage because when I started, well, first of all, they didn't have these cool webinar things like we do now. You couldn't do it from the comfort of your home. You had to go sit in a hotel, and maybe some of you guys remember this, but you had to go like on a Saturday. You spend about 3 or 4 hours listening to some presentations in a hotel. Next thing you know, you're paying to go on Sunday to spend the whole day there. Maybe you learn a tidbit or two. Next thing you know, you're on an airplane and you're flying to some destination to do an intensive program. That first year, I spent $27,000 on seminars, which was a lot in 1997. But then I tried to do some of the strategies that I learned, and I wound up losing 85,000 in bad trades. And again, I don't know how many of you can identify with that, but that 27 and that 85, right? That 100 and whatever it is, $112,000 was more than I had spent on all of my undergrads and master's degree. And again, I just considered it yet another degree that I was getting. But that's where we all kind of start, right? But the key is can you get quicker through this part? And so I actually would love you to take notes on this one part of my presentation, and that's how to crack the code, right? If you're struggling with that right now and you're looking to be a successful investor, first of all, stop chasing shiny objects, right? In other words, figure out what works for your lifestyle, not your dream lifestyle, but your lifestyle right now. Like if you're somebody who is pursuing a career as a doctor or something like that, where you can't step away from your, patient when you get a trade signal, then maybe that type of trading is not right for you, right? I had a program participant that went really far in my program and now is really, he touches base with me periodically. And the guy climbs around HVAC ducts all day. And there's no way that he's going to, when he's pinned inside of a duct, he's going to be able to pull out his mobile phone to place a trade, right? So just be honest and take inventory of what your lifestyle is. Find a type of trading or investing that works with what your lifestyle is or what, and then focus on it, master it, and don't get distracted. That's number one. Number two, look for a mentor who is currently doing what you want to be doing and even more knows how to teach it, right? You have no idea how much money I have spent on folks over the years who I know I was watching them do trades. I was watching them invest, right? And their portfolio was right in front of my face. I knew how much they were making. and they couldn't teach me, they couldn't convey the knowledge for me to build my skill to save their life, right? And so make sure, you're hiring somebody like a Jeff or, make sure they've got somebody who can convey that knowledge to you, right? I call that learning by guided discovery. And this is the number one thing that's going to shave off the amount of time it takes you, because learning by trial and error is a great way to learn. Don't get me wrong, but you're recreating the wheel and you're basically doing what I did, which took 8 years before. It took me like 3 or 4 years of really losing a lot of money before it started to click, right? It started to click that the market wasn't going to move because I said it should move. I had to follow on big traders' footsteps. So learn by guided discovery. Finally, not finally, this is number 3, join an investment group, right? In other words, and again, I'm really not looking forward to the conversations I'm going to have with the school system when my little girl is in there. But I remember they used to teach us to not cheat, is what they said. Don't look over people's shoulders, right? But when I was at Hewlett Packard, I learned a big lesson, right? Whenever Epson or Canon would release a new printer, we would go and buy that printer, and the engineers would take it all apart, and then they would find something that they could increment on and make it better. And then we had our next line of printers, right? That's how we did it. You build, you build on the next person's ideas. So you want to join an investment group and you want to look over people's shoulders and you want to leverage with pride. If they found a good symbol that they're selling premium on month in and month out, if they're using weekly options week in and week out, you should be doing that too. And if you can add something better, do it, right? That's what it's all about. And let people look over your shoulder as well. People will learn from your mistakes. People will learn from your wins. Get into a group. Don't do this as a lone cowboy, cowgirl, cow person. Finally, surround yourself with like-minded investors, because naysayers can really just screw with your head. I have a family of naysayers, all a whole bunch of Italian immigrants that, the idea of investing and not burying your money in jars in the backyard blows their minds. And they told me I was stupid. And every time I had a losing trade, they'd laugh at me. But now, the scoop is you need to be around with people that'll not only celebrate your wins, but will also tell you, hey, that happens, keep going, right? And so this is exactly what I did, and I recommend these 4 steps to you too. I hope you took some good notes on that. And last but not least, I always have to tell people about the foundation I started in 2003, where I take historically underserved inner city kids off the street. I teach them how to invest. In fact, in 2003, when the public library only had DSL lines, you might remember that, these kids, um, they limited us to 30 minutes a day on the computer. So, in 6 months, I worked with these kids and I actually gave them each $2,000 of my own money. And I didn't think I'd ever see it again. Every single one of those kids paid me back. One of them is a professor at Denver University now. One of them actually works for me as one of the coaches. They all went on to, getting their own computers and their own DSL lines and doing this full time. And we've done this every year. We had to take a break during the pandemic, but we're back at it. We've moved it from the suburbs of Denver to Chicago, where there's a lot of historically underserved inner city kids on the south side. We've partnered with the CBOE, and last year we graduated over 100 of these kids. So that's my main focus. That has been my main focus till my daughter came around. So back to the topic of premium. Somebody said, "Hey, what about selling premium?" This is what I'm going to focus on, and you guys probably already know this, but I like writing covered calls. I know it sounds simple, but writing covered calls. Now, the other thing, and especially with the way that things are turning, you got to know how to write covered puts, right? That's flipping the covered call upside down. If you only have covered calls in your tool case, you're going to be missing out on a lot of stuff, especially for the rest of 2024 and 2025. So make sure, and I'm not going to spend much time this evening talking about covered puts. So you should definitely Google it and make sure that is something fresh in your mind. Writing covered calls against leaps, right? So instead of having your initial covering position being a long stock, let's do a bull call diagonal debit spread. Let's get ourselves a deep in the money, far out in time, call option, and then we'll write near term at the money calls against that, right? And so you guys who are academics know that that's a version or a variety of a bull call diagonal debit spread. I like to leg into my positions. We use leaps most of the time because of the liquidity. That's got to be in your wheelhouse. And of course, writing the covered puts against leaps, which is just the corollary to writing covered puts, bear put diagonal debit spreads. Definitely these 4 transactions are my favorite to trade. And if you wrote down those 4 transactions, which you should have, mark them somehow, the covered calls, the bull call diagonal debit spreads, and the bear put diagonal debit spreads, mark them somehow so that you know that those are cash trades. All of those are trades that we can do in even a retirement portfolio, anytime you have a cash account. And just know that covered puts does require you to have a margin account because the initial covering position is a shorted position. But now check this out. If you don't have a margin account or you're trying to do this for the tax implications where you do it in a cash account, and I love good tax implications. The scoop is you can get the same sort of action of doing a covered put most of the time by doing this one, and this one does work in a cash trade because your initial covering position is a long trade on a deep in the money, far out in time put option instead of shorting a stock. Both of those initial transactions are regarded by our brokers as a way to cover selling put premium. So keep that in mind. There's always a way to do anything you need to do. Okay, so now that we know that, you might hear me keep talking about this term premium, and it might be a different term than you have used in the past. What I'm talking about is those 2 components that make up an option price, right? The in the money value, aka the intrinsic value, and the premium value, aka the extrinsic value. So when you look at the option price of something flicking up and down on the big board, it's a combination of the intrinsic value, the extrinsic value, or my street names that I use, in the money value and premium value. Some people like to refer to premium as the time value. That has always irked me a little bit. And that's just because the component, the premium value, has so much more packed into it than just time. So that's why you'll never hear me call it time value. I always call it premium value. And that's what I'm talking about, selling that premium value. All right. Let's take a look at this trade on Lyft. Actually, this is not a trade on Lyft. I might have labeled this wrong. Let me see if I can fix that really quick. This is not Lyft. This is Ford. No, I'm over here. I'm looking at Thinkorswim right now. It's actually AT&T. Let me see if I can change it on the fly here, because I looked at this right when the market was closed. This is just a theoretical trade, but then I'm going to show you a real trade that we did doing just this. But let's look at this. Let's see if I can get that to update. Maybe not, but that's fine. We'll just, I don't like it. Let me fix this. Escape. No. And then I'll start all over again. That's okay. It'll update. I know it will. It doesn't want to update. Let's say save, and I just bear with me here. We'll close, and then we'll come over here and we'll say open, and I'll bring that back up. It's going to ask me if it should update. Yep, there it is, update. And then we'll go down to our slide that we were just on, because I really want to show you how this is, and I don't want to give you any false ideas. Let's give it a second to update. It says it's updating some links. It's thinking about it. While it's thinking about it, I'll just take you through. I'll pull it up on my Thinkorswim, which I have right here. All right. So on my Thinkorswim here, if I went with the closing price of 1947, let's see if I can get this to update here because it's better visual. It really is. Do, do, do. See if we can get this to update in real time. Otherwise, I'll just write it out. Yeah, I'm going to write it out. So if we, in fact, what I'll do is I'll pull out my little magic marker here. And we'll talk about if I was to buy this particular stock for $19.47 per share, right? And then, oh, there it comes. Nice. This is going to be better if I can show you the picture. So let's just come right here. And thank you for your patience. From current slide. 1947. That's actually not the right slide. It's taking a second. We're going to go back a little bit. Here we go. AT&T, $19.47. What if we bought that stock and then immediately sold back the 1950 call for 31 cents? So one of the cool things here is you create for yourself a instant dividend is what I call it. It's not actually a real dividend, is it? But it's a premium that we collect by selling to open or writing this call against this stock. And because options are in increments of 100, right? For every contract we sell, we get $31 back. And don't forget, we're selling to open, and so this thing acts like a coupon. As we go closer and closer to August 16th, which is in about 2 weeks or about 11 trading days from now, this is going to get closer and closer to zero until on the day of expiration, there's going to be no premium value left. So what happens? Let's run through the 3 scenarios that can happen on August 16th. If AT&T is above $19.50, we're going to get exercise. So we spent $19.47 for every share of AT&T. We get $19.50 for being exercised. That gives us 3 pennies of profit. That could probably get eaten up on your commissions, by the way. But don't forget, we collected 31 cents up front for a total profit of 34 cents per share, or about 1.7% ROI. Now, remember, this is about 2 weeks. This is not a full month, but still 1.7% ROI. That's okay. But now our ideal case is what happens if AT&T goes flat, right? If it goes sideways by August 16th. So you spend $19.47, you get your 31 cents back. It actually expires worthless, and so you get to keep that 31 cents. You make 1.6% ROI, still not the numbers I'm looking for, but we'll be able to do it again and again and again. And remember that 1.6 number is for about 10 days of trading. It's not for a full month. But still 1.6, if we multiply that by 2, that's 3.2%. There's got to be, we've got to have a better opportunity here. Maybe we'll talk about that. We will talk about it. But now, wait, what if AT&T drops by August 16th? So you spend $19.47, you get your 31 cents. Well, I'm going to show you right in probably about 7 minutes from now, if my timing is right. I'm going to show you how we can, reduce that risk on reward even further. But just know that built into this covered call writing strategy is actually a profit buffer, isn't it? Because we've reduced our break-even price by 31 cents. that means we don't even go into the red until the underlying symbol dips down below 1917. So we already have kind of an inherent, by moving that profit and loss diagram over to the left, we have that inherent kind of, breaking of the hedge, right? Now I would like to show you an actual trade that my team and I have been doing. We got our trade log right here. This is on Ford. We actually started, and here's something a little different. I want you to notice that we're using an indicator kind of like the one that Jeff has available that identifies tops and bottoms. And so we're actually legging into these positions. We're not doing the two transactions at the same time. We're simply just using those indicators to tell us when to do each one. So on January 29th, we bought 900 shares of Ford. On February 16th, we sold some premium, 23 cents. April 9th, we sold some more premium, 80 cents. You can see these are the days that the options expire. We did it again, April 26th, 35 cents. June 3rd, 45 cents. July 9th, 26 cents. So we did a total of, besides opening up the initial position, 1, 2, 3, 4, 5, 6, 5 actual premium sells, and then we got called out. So we actually, this trade lasted for us from the end of January until the third Friday of July. All we had to do is once a month come in there and do one of our adjustments, do our premium sell. And we wound up walking away after all that time with about 30.4% ROI. Dude, you can't get easier than that, right? So just to make sure we're all on the same page, answer all that apply, and I'll look over here. What does investing by selling premium create? And when I say answer all that apply, that probably means that there's more than one right answer. Does it create an instant dividend? Does it create a discount on a security? Can you get your security at basically a discount? Does it create a profit buffer? Does it act like an expiring coupon? Which of those are the right answer? What do you think? What do you think? If you're thinking all four, you're absolutely right. That's exactly how selling premium works. Now I'm going to start to get a little bit more, go a little bit faster here. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? Should we be selling farther out in time options? Should we replace the security with options trading at parity? Should we give up and just go back to buying mutual funds or some other type of more passive investment? Or is what I'm talking about not even possible? What do you think? What do you think? So some people are, I can see a lot of people are getting my intended answer, but some people are jumping towards this one, which is the sell out in time options. Listen, if you ever take a look at the time decay curve or the theta decay curve of options, you'll realize that, first of all, when you sell an option, you're under an obligation to perform, right? That's the definition of the option, right? When you sell an option, you get a premium, but now you're obliged to perform. The person who bought those options from you has a right to do something, but you have to be there and be obliged. That's kind of like a commitment you go under. If you sell farther out in time options, you're under that commitment for a longer amount of time. However, if you look at how much more incremental reward you get for taking on that additional time, the juice ain't worth the squeeze, right? The real gains are if you stay near term. Our target is 3 to 5 weeks to expiration, maybe even less, depending on the premiums. So it turns out the real answer here, and you might want to update your notes with this, is let's see how we can reduce the overall break-even price by replacing the security with an option trading at parity. And so that always brings up, what the frick do you mean by trading at parity? Okay, so we know that option premium, that extrinsic value, is the most when the option is at the money. But if we go very deep in the money with our option choice, it's going to have very little premium. And we like to target less than 5% of the value of the option being extrinsic value. And the rest is intrinsic value or in the money value. That's a lot of word salad. Let's break it down. If you go deep in the money, your option is going to behave exactly like the underlying security, right? If the underlying security goes up $1, then your option that's trading at parity goes up $1, down $1, down $1. They behave the same, right? This is where we start talking a little bit about leverage. It moves dollar for dollar, but that substitute option is at a cheaper price, right? So that's kind of neat. We introduce a little bit of really strategically placed leverage. Now, of course, we're talking about substituting a stock that doesn't expire, whether it be a long stock or a short stock, with something that does expire. So how far out in time should we go? Well, first of all, we want to go far enough out in time so that we can sell a bunch of premiums against it and not have that. It's like owning a rental property and wanting to get as many years of rent out of it before the building disintegrates, right? You want to be able to sell as many premiums. You just saw that we have a Ford example that lasted for five cycles of selling premium from the end of January till July, the third Friday of July. So we need something that's going to last that long. It turns out, if you look at statistically with our premium selling, and I've looked and I've dissected the folks that have been in my program for the last 20 something years, the bell curve is at 5 months, right? But it's a flat bell curve, and you see, just as many people getting exercised or called out or bailed out at 4, 3, 2, and 6, 7, 8. The real drop off is after 8 months. So what I tell my folks to do is make sure you pick an option that's at least 8 months out in time. And a lot of times we're attracted to the leaps just because they've been around for a while, right? In September, we're going to get the 2027 leaps, right? And so the leaps are always been around and there's activity on it. Remember, when we're trading options, we're the ones who create the option contracts. It's not like stocks where it's the company that releases a certain number of shares. You got to have some stuff to trade, right? Just because the OIC gives us a trading, structure doesn't mean that there's actual open interest in people trading options. So the leaps are around. They've got liquidity. We're oftentimes attracted to the leap unless it's a big name and, there's a lot of people trading the options. So that's the rule of thumb. Go at least 8 months out. Go very deep in the money. Target less than 5% premium, over 95% intrinsic value, and, look at liquidity. And if you need to, go to a leap. So let's take that example that I found at today's close. I could be buying shares of AT&T to do my trading strategy at about $19.50, $19.47. Or guess what? If I use the AT&T May option, now that's not a leap, but AT&T is traded heavily and the options chain is quite liquid. If I use the AT&T May 2025, that's more than 8 months out in time, $13 call, the thing only costs $16.65, but guess what? You look at the statistics, that's almost all in the money value that's going to move dollar for dollar with AT&T, but it's around a third of the price, a little less, a little more than a third of the price. So if we go through the same scenario, instead of buying AT&T at $19.47, I'm buying this back month call option for $6.65. I'm still selling the near term at the money option, the one that expires in just a few days, for 31 cents. Get that instant dividend. It reduces the cost basis on that security, that back month security. It acts like an expiring coupon, all of the above, right? If AT&T closes above that strike price of $19.50, well, we spent $6.65 on the back month option. We're going to get the difference between the strike prices. That's why it's called a spread. So we're going to get $6.50. Uh-oh, that results in a 15-cent loss. How could that be any good? Well, don't forget we collected 31 cents up front, and now our initial break-even price is so much lower, we wind up with way more profit than we did in the first scenario. This is 2.4%. Remember, that's only for 2 weeks. Now you're getting up closer to that target that we're looking for. And this is, a strategy placed where we do both options on the same day, right? Not even legging in. What if it's flat? Remember, this is my ideal case. I love sideways, choppy moving stocks. If it's flat, I pay $6.65 for the initial covering position. I get my 31 cents of premium. I keep my 31 cents of premium when it expires worthless. I've made 4.8% ROI so far for just being in this trade for a little around 2 weeks. And I'm going to get to do it again and again and again. And finally, what if it drops? Again, I'm going to show you that risk on reward thing that we can do to make it even better. But built into this strategy is this profit buffer where we reduce where the break-even price is for going into the red. This thing has to be trading all the way down below $6.35 before it's a losing trade for us. Now, of course, I'm going to show you the real trade. And it just so happens the real trade is also on AT&T. Here's the real trade. There it is. Let me take you through what we actually did. And this is legging into the position. So again, November 20th is when we started this. We decided instead of buying the stock, we would buy the back month option, $6.05 for 20 contracts. And then we started on December 10. We sold 20 contracts of premium, 13 cents a share. Next time was on January 8th, 38 cents a share. Next time was on February 2nd, 22 cents a share. Next time was on March 22nd, 31 cents a share. Then we wound up skipping a little bit and not selling premium till June 5th, where we actually got exercised. And we were selling the $17 and $18 calls against this thing. And when we finally got exercised on our $18 call, we had to do, the simultaneous exercising of the $10 call. And so we got the $8 difference. We walked away with 56% ROI on this trade. And all we did was about one transaction a month, and we took a break between March 22nd and June 5th. So we took April and May off because we weren't getting our signals. This is the type of trading I like to do, where you do these end of day analyses, you decide to do a trade, you set your conditional orders that evening, and the next day it fills or it doesn't fill, and you decide whether to carry over. But you do everything at 10 p.m. after your toddler's gone to sleep and you've spent the whole day with her, right? Very cool. So, just a reminder, I focus on that 6% per month number so I can double my portfolio every year. Last piece of this puzzle, and then I'll be done. How can we drastically reduce our risk on return? What should we do? Should we focus on, instead of selling all the premium we can, sell half of it? Should we sell farther out in time options? Maybe we should be collaring this whole premium selling investment with protective options, or is what we're not doing not even possible? What do you guys think? I see you guys coming in with your answers. Here we go. Let's collar the investment by marrying protective options, right? So the best way to give you this example is, again, just to show you a real life trade. And this is right out of a textbook. this trade that I'm going to show you. Let me go ahead and pull it up. I'll bring up that trade worksheet. This is one that I did that actually, remember I said that trades typically last less than 8 months. This one lasted 14 months. And that has only happened to me, maybe I can count it on 2 hands since I started trading in 1997. But this was Pan American Silver. And I just want to point out a couple things about this particular trade. I started off by doing 600 shares at $34.73. There wasn't very much liquidity on the back month options. And so I went with the stock, even though it was a little bit higher price than I usually like to pay for these things. Then I sold premium, but at the same time I sold premium, so I made $1.76 selling premium. I also bought a protective option. I bought a protective put. And you'll notice I bought a $34 put, right? So basically, first of all, I'm using protective options that are about 3 to 6 months out. That's my target, is 3 to 6 months out. And I usually select the strike price around where I want my protective option to kick in. So usually around my break-even price, maybe a little bit lower, right? So I spent $4.75 on that protective option. So what happened? The third Friday rolled around, my premium expired worthless. And then check this out. A few days later, I got the signal to go ahead and roll out of my protective option. So notice this, right? I bought my protective option for $4.75. When I got my signal to liquidate it, it was worth $5.90. So not only did it protect my trade from September 1st to September 24th, I also, because of the way that I only purchased it when I sold my premium, right? Remember how I mentioned when you sell premium, you put yourself under that obligation? That's the best time for us to use a protective option. A lot of people throw the protective option on when they do the initial covering position, right? Even though the symbol's probably going in their direction. And the scoop is you could use a stop loss order on that initial covering position until you sell your premium. Then the trade gets a little bit more difficult to unwind. And that's the time when you sell your premium, that's when you put your protective option on. And it has this other side effect that now you're buying it at the lowest price you can, because when you sell premium at the highest price you can, your protective option costs the least. And usually when you get your signal to roll it out, you can roll it around. And now you're getting 2 sources of income, not just the premium income, but also the rollout of your protective option every cycle that you do this. So we've turned something, putting a protective option strategy in place, from being something that usually is a cost center, something that is an expense to the overall economics of your trade. We've now turned it into an additional profit center, right? And so that's cool. The first time I did this trade, I got $1.76 from the premium, and then I got $1.15, which is like frosting on the cake from rolling out the option. And then I did it again. $1.47 for the premium. I bought the protective option for $3 and a penny. The premium expired worthless. And when I got the signal a few days later to sell the protective option back, $3.62. I made another 61 cents rolling out the protective option. And I did it again. And I did it again. Rinse and repeat. Now I get it. I've added a little complexity. Instead of one transaction every month, I'm doing basically 2 days of trading every month. And on one of those days, I'm doing 2 trades. I'm selling the premium and I'm buying the protection. And then I'm looking to roll out the protection at the end of the month. Right? The other thing I'd like you to notice is over here, I have a column that keeps track of the break-even price as I buy and sell, and it factors in my commissions, right? Notice after the first cycle of selling premium and buying protection that my break-even price is now trading lower than the $34 protective option strike price. So what does that mean? What does that mean when you've got protection that's going to kick in at $34 break-even price, but your actual break-even price is lower than that? By the way, that PAAS trade is the one that I graphed here. So this is revisiting that graph. You've got your break-even price. And so a lot of folks are always coming up to me and saying, AJ, with this strategy, what's your win-loss ratio, right? Kind of stuck in that directional mode, right? But the scoop is because I'm trading time as it passes by, what's really cool is if I can stay in these positions for more than 1 or 2 cycles, this is the number of cycles of selling premium that we've got here. They very quickly become, because of all the premiums I'm accruing, risk-free trades, right? Meaning that if the underlying symbol goes against me, that's what the range low means, versus going for me, I'll still make money because I've been collecting premiums along the way. In fact, the average time we talked about was 5 cycles or 5 months of selling premium. In the case of my PAS trade, if I got exercised at 5 months, I'd walk away with 65%. If I got stopped out, I'd still walk away with 50% ROI. Because again, what we're doing by selling premiums is really focusing on not the directional component of options, but that theta decay. So it's more about time moving by, right? A very predictable pattern to trade on. The other cool thing, and again, I've been harping on this, is it was within the first month that this position, this long-term position I put on, was now risk-free, right? There's no way that I could walk away from this trade, even if the underlying symbol went against my directional move, right? Without profit. I was going to be guaranteed some profit early on in the first month. And that's how we like to structure our trades. We like to be very, very strategic in the planning. And we like these things to last as long as possible so that we minimize the amount of time we have to research the underlying symbol. If you can stay in a symbol that you already have a relationship with for 5 or 6 months and just adjust this trade once or twice a month, it kind of becomes, like an everyday thing. So just to drive it home, and then that's the end of my presentation, is what do we have when our cost basis, our break-even price is less than our protective bailout price? What do we have? We have a risk-free investment. Is it a losing trade? Too much complexity? Have you been hitting the crack pipe? The answer is we've got a risk-free investment, right? So that's kind of how we structure our trade. So let me review for you the 3 steps to do these positions. Number 1, you're going to buy or short an underlying symbol. So shorting has to do with that whole covered put thing that we really didn't get to cover much today. But when you go and research it, you know that shorting. The other option or the other choice you can make instead of buying or shorting an underlying security is you can buy a substitute option that is trading at parity. That's step 1. Step 2, you're then going to sell a near term, and I'm talking about 3 to 5 weeks to expiration, even less if you've got the premium there, at the money option for its premium value. You're going to create that instant dividend and simultaneously a profit buffer. And then you're going to collar with a married option that's 3 to 6 months out in expiration. That's going to protect your investment, right? And then rinse and repeat until you either get exercised or stopped out, right? We talked about a little bit like the use of these different indicators. I've got some, but I have to be honest, Jeff's take it to the next level so you can combine the stuff that, he's got. The scoop is when you've got a sideways choppy stock, if you're going to do a strategy like the covered call or the bull call diagonal debit spread, you start at the bottom of the channel. When you get that signal, that's when you either buy the underlying symbol or you buy the call option trading at parity. You put your bailout order in place, your stop loss order in place. Then you get your top signal. That's when you sell your near term at the money call option and you buy your put option, your protective put 3 to 6 months out. When your near-term option expires worthless, you then look for the opportunity to sell back your protective put, rinse and repeat rinse and repeat, rinse and repeat. And again, we didn't cover it much, but if you're starting at the top of the channel, that's when you short your underlying, or you buy that put option trading at parity. You put your buy to close stop loss order in place. You get your bottom signal. That's when you're going to sell your near term put option, buy your 3 to 6 month out call option. Put option expires on the expiration date. If you're doing weekly options, that's every Friday. If you're doing monthly, it's the third Friday of every month. And then you look for your top in order to sell back your protective call. Rinse and repeat, rinse and repeat, rinse and repeat. So how would you like to never miss a pick, minimize the amount of time you spend away from your loved ones, or and have support whenever you need it for doing this particular strategy? Maybe you want to, do this on the background, put a certain part of your portfolio into the kind of these like automatic, type of trades that are little no-brainers, and then focus on some more active trading. Because that's what it's all about, isn't it? It's about saving time. It's about creating clarity. It's about getting the results that you're looking for, right? So could I take a moment right now to tell you a little bit about my trading trainer program, my materials, my tools, see if it might be something you're interested in? Cool. First of all, who really is the type of person that comes over and checks out Trading Trainer? Someone who doesn't want to pay for multiple data subscription, wants everything they need in one place, doesn't want to miss any opportunities, wants to spend more time doing other things, doesn't want to do this alone, wants step-by-step instructions. In other words, to sum it up, they want to get consistent and reliable results. Now, of course, one thing I say is make sure you're ready to be disciplined, right? I'm already way late here, folks, so I'm gonna skip this testimonial from Charlene. But if you ever get a chance and you're on our social medias, check out Charlene's story. It's pretty cool. So just to give you kind of an idea, when you are part of our program, you get access to our web portal. I have our web portal right here. Let me see if I can pull this thing over here. Maybe. There it comes. You get access to the web portal. It works good on mobile phones. It works good on tablets like iPads. Works great on desktops. And you get access to all kinds of things. You get access to all sorts of tutorials. And then we have a once a month kind of lecture series that we have archived back to 2010. We actually started this premium selling program in 2007, but our archives, I lost some stuff in the beginning there. So you can actually watch replays of these monthly webinars all the way back to 2010, and they're all categorized by keywords, so you can search them too. We also do a weekly workshop. This weekly workshop is where, and we just had one this afternoon, where we take a candidate that is crowdsourced from everybody on the workshop, and we actually plan it out, and we create a trade plan around it so that everybody can take that trade plan and either trade it as is or move forward. So everybody, they learn while they do, right? We've got a whole bunch of tools, like planning tools. I've got a tool right here that we filled out just today on ticker HL. We planned out a trade on HL. Here's your covered call plan, your covered put plan, your bull call diagonal debit spread, your bear put. Basically, we go through together and we figure out with the configuration wizard, we answer these questions and you get your trade plan. And then you even get a testing wizard where you can test your trades as they come along to make sure you're following your plan. So we give you all these different tools. We've got a place. Here's my favorite part of our program. People can send us any trade plans that they've created on their own. and we'll give you a review of your trade plan. So you can get trade reviews, as many as you want, to make sure before you actually start executing on a trade plan and start doing one of these positions, you'll get us to, give you any kind of insights onto any sort of gotchas. We also have a heck ton of screeners. We've got our main screener for finding the best underlying symbols to do this against, as well as a whole bunch of beta screeners, because I'm constantly fiddling with different ways of finding the best candidates to do these type of trades on. So what is this all worth to you, right? If you got your video tutorials on how to get the premium selling going, your monthly live classes and all their replays, the screeners, the planning tools, the weekly live workshops where you can answer any questions, or if you can't attend them live, watch their replays. All the workshops and all the classes are transcribed, so if you're not somebody who likes to watch videos, you can just read them. The trade reviews, what's that all worth to you? Because I'm also going to make sure you know about my double your money back guarantee. So I like people to work with me for 6 months, not because I think it's going to take you 6 months to learn how to do this. Usually people pick it up in 2 weeks or 3 weeks, especially with your experiences. No, it's because I want to give you those trade reviews, and I'd love for you to attend the weekly workshops to get, look over my shoulder, leverage with pride on symbols that I'm planning out, how I do the planning. And then we even go back once a month and follow up on all the trades that we've been doing based on the planning we did the subsequent weeks, right? So I want you to be part of that for a full 6 months. Plus, I've always done things for 6 months, like I did with my initial class into my my charity. Uh, in 6 months, you can really pick things up by looking over people's shoulders. So do the program for 6 months. If you're not making money, then show me that you're definitely doing the type of trade. Show me the trades you've done that are following our program program thing. And if you didn't, if you prove to me that it didn't work, I'm not only going to give you the amount of money you paid for my program, I'm actually going to give you double the money. And it doesn't have to be real money trades. You could be doing paper trading for all I care. If you can show me that, what you're doing is exactly what we taught, you're doing some of the trades from the workshops and it's not working for you, I'll give you your money back ×2. It's called a double your money back guarantee. And for this group, for Altos, I want you to talk to one of my one-on-one coaches. They're so good at helping you take inventory of where you are right now and where you want to be in the end of the program. And they'll help you navigate the best course for you to take in that one session. So add that in, the double your money back guarantee and the bonus strategy session. And now my question is what's that worth to you? Because if you go on my website, you'll see that it's $597. It's a flat fee. There's no other charges, and that's the 6-month program. And because Jeff is freaking awesome, I'm taking $100 off. So this is what you have to do to get the $100 off. First of all, you're going to go to optioninvesting.org/Altos. Altos. And I've got this up on an actual browser window here. So if you go to optioninvesting.org/Altos, you should get to a page that looks like this. And it's got the regular price. So here's the other key thing you have to do. You got to go down here where it says promo code. And this is the promo code you're going to use. 100 capital D, capital I, capital S, capital C. And I'm actually doing it live because I want to make sure my programmers did it right. Let's click apply. Yeah, they did. So it drops the price by $100. So the promo code is 100DISC, disc, like discount. You can see it right there. Put that promo code in and it'll reduce the price to $497, and it'll be a 6-month program. Again, No other fees. I'm not going to bill you every month. There's at the end of the 6 months, it's not going to continue. It's just this flat fee, but we're going to work together on a weekly basis, if not a daily basis. If you have any problem, if you are interested in this program and you have any problems with any, getting that shopping cart to work, just call us. We've got people on the phone all the time, or if we're busy, we'll definitely call you back. That's the phone number right there. But let us know, and we'd love for you to be part of our program. And if not, I hope you walked away with some insights today on selling premium. Maybe this was a review. Maybe you have a better way of wrapping your head around things, maybe a different way. But again, optioninvesting.org/Altos, promo code 100DISC. This will be good. I think that we're scheduled to take this down on Sunday night. So you have a few days to think about it. Then that promo code won't work anymore. And the promo code also includes the free coaching session. So thank you so much for your time. Let me see really quick about questions. Can this be done from Australia? Yeah, it's funny. A lot of the brokers in Australia and the brokers in Canada have had some issues recently, especially with the options market, especially with some of the rules around having to have a presence in the country. But there is ways around all of that. There's interactive brokers. There's definitely ways, because I have a coach, actually two coaches, Kathy and Megan, who are based. One of them is based in Canberra, and one of them is based, I think, down in Melbourne, where they, teach my folks in Asia. And I've got a bunch of people in Australia and New Zealand, as well as a couple of people in Singapore and a couple of folks that have been with me forever from Hong Kong. So we've got folks there, and I know it works, but I'm here in the States, so I'd have to put you into contact with them. Are we buying puts or calls? So in the case of the only options we would be buying would be either the initial covering position, so that initial position that allows us to then sell premium in the future, could be a call or a put, depending on whether you're doing the bull call diagonal debit spread or the bear put diagonal debit spread. And then the protective options is where we're buying options. So if you're doing a covered call or a bull call diagonal debit spread, you'd be using protective puts. If you're doing a covered put or a bear put diagonal debit spread, which is its corollary, you'd be using protective calls. So you just got to, and that's why, let me just show you again my little trade plan. My trade plan over here that comes up from our little planning tool that we give everybody. It tells you, for each one of the strategies, like for instance, if you're doing a covered put, you're going to be shorting your shares of stock, and then you're going to sell to open your puts, and then you're going to buy your protective calls, and then you're going to roll out of your protective calls. So each strategy is a little bit different. So that's from Russ. And Russ also asks about, could you do weekly options? And yes, you basically you trade the signals as they come. And if you're using weekly options, then just focus on, 3 to 5 weeks out to expiration. You'll find a lot more liquidity. And if your portfolio starts to get larger, you'll probably be focusing more on the monthly options like I do, because there's just not as much liquidity in the weekly. But the weekly are great if you're starting out with a smaller portfolio. And I think that's all the questions I
Hey, AJ, I'm
asked.
I'm not sure if you have the chat pulled up, but there are some questions in the chat. Joseph asked what the recommended investment to start out with is.
Oh, good. Yeah. Like I mentioned, I've had folks start with as little as $800, but when you have that small of a portfolio, you're limiting you won't be able to have the cream of the crop, the pick of all the underlying symbols, because you'll be taking on more risk than your portfolio can have. So you wind up limiting what symbols you can get into. I find that the critical mass where you can start to basically sell premium on pretty much all the different symbols out there is around $5,000, right? $5,000 portfolio. An interesting story is when you get a big portfolio, and I know this is like some people are like, why are you talking? But you'd be surprised how fast you could parlay like a 5, 10, even $20,000 portfolio into when you start to hit that quarter million number, it starts to get limiting again because now it's a liquidity issue. You're going to want to trade so many contracts on a particular, underlying stock, and it turns out you're the only one, you find out that you're like the majority of the liquidity on that option and you don't want it. So it becomes limiting again where you are focusing on bigger name companies. But the scoop is that the companies that I target are boring. They're not going to be in the mainstream media, right? Because when you're in the mainstream media, the patterns become less predictable. And so these premium selling positions, they're sideways channeling. They're basically range bound option trading strategies. We like things that are in a range. And so you don't want anything that's going to throw a wrench in the works, like somebody talking about whether the Teslas are going to be recalled or not, right? Or whether Elon Musk, passed gas on Twitter or not, right? So you're not going to be, we like companies that are, you know, established. They're making money every earnings season. Even better if they're giving their investors dividends, right? Those are the type of tried and true defensive stocks that find themselves in sideways choppy patterns for a long time. And those are the prime candidates for us to just sell premium on every month. So yeah, that's a good one. Um, my main interest, I see something from Steve early on. He's like, I want to survive a catastrophic stock failure. So that's when your protective options need to be kicking in. Yep. Bill, 14 months. That was mind blowing. I couldn't believe that trade just kept going on and on. That was Pan American Silver. In fact, I've traded it since, and I've gotten like 3, 4, 5 months of premium out of it. But that one, uh, uh, right during the pandemic, when a lot of folks were kind of wondering what to do with their money, and they were putting it into precious metals, that one was a nice one. So, are you buying synthetic long stocks with long calls and a short put? That's a great strategy. And if you are part of our program, you'll see that there's an area in the web portal where we talk about other strategies because I have traded other strategies. In fact, I have another program where I've got full-time option traders that are trading everything straddle strangles, condors, butterflies, things like that. And so we do have an area where you can talk about those type of different strategies, but this is simple: covered call, covered put, or, bull call diagonal debit spreads, bear put diagonal debit spreads. And they're actually, if you look at a Venn diagram, it's a very particular type of debit spread, diagonal debit spread that we're doing, where the back month is one that's deep in the money, trading at parity, far out in time. And yeah, so it's a really, not rocket science, not getting too crazy there. I think I've answered them all. I don't see any other. Maybe I'm not.
Looks like there's Marco asked if this is something that would work for beginners.
Yeah, that's usually the folks that are interested in our program. We get a lot of folks that are um, getting towards, retirement age and realize that they're not going to be able to, um, you know, live the way they want to on their retirement. And so they're just now getting into investing. We also have quite a few folks in their early 30s that realize that they probably aren't going to have a retirement when it comes time to retire, or they don't think they will. So they're going to start now building up this nest egg while they're still working and still in their prime. That's kind of what my story was, right? Um, so yeah, it definitely is for beginners. In fact, I would almost argue that folks that have um, insights into different types of tradings almost come with a deficit because it's hard for them to get their head wrapped around just selling premium and not chasing swing trades or directional trades all the time, but just letting that clock, like people get antsy and they want to pull the trigger, and really you just wait for your end of day signal and then set your conditional orders for the next day. And you just play it as it comes. It's not something that you can actively make happen. So yeah, I would say beginners are actually my cup of tea.
Cool. Yeah, Russ had a good question. What percent of your account do you allocate to a trade?
That's a great question. So you'll notice here, and so there's no flat number. What we do and what this planning tool does is this planning tool calculates for the trade that you're looking at what your worst case scenario would be, right? The worst case scenario in these trades is actually if you place the two trades, the initial cover, at the same time. It's when you split them apart that you can actually, reduce the risk and increase the reward. So what this tool does is it says, what's the worst possible loss that we can have on this trade? And from that, it then says, it asks you here, take a look in the configuration wizard up at the top. It says, how much of your portfolio are you willing to risk? And so you put in a number like 2%, for instance. That's what I've got in this trade. And it'll actually give you a recommendation. This recommendation is based on what I've seen over the years. When you have, a bigger portfolio, you never want, in my opinion, you never want to risk about 4% of your portfolio in any trade, right? If you want to be able to make 25 mess ups in a row before you're out of the game. And in my opinion, if you've made 3 mess ups in a row, not just mess ups, but mess ups that go all the way to the worst case scenario, you should stop what you're doing and go back and like look at your process, because if you get 3 of them in a row going to worst case scenario, it's not it's not the market throwing you curveballs, it's something you're doing, right? I'm a firm believer in that. So I call it the hat trick, but it's the opposite. It's not a good thing. So in this case, I'm risking up to 2% of my portfolio. Let's say, for instance, we look at the worst case scenario and we determine that the worst case scenario of this trade would be 10%, meaning if you placed this trade and it lost to the worst case level, you'd lose 10% of the trade. So then what this tool does is it says, okay, if you can lose 10%, but you're only willing to risk 2% of your portfolio, that means you can only put 1/5 of your portfolio into this trade. Because if you put 20% of your portfolio into that trade and you lose 10% of that trade, you're only going to lose 2% of your portfolio. So it depends. And you'll notice that this tool is giving you a recommendation of position size. And so what we find is if you're doing covered calls and covered puts, your position size is probably going to be anywhere from 10% to maybe even 30%. You could actually have your portfolio fully invested in anywhere from 3 to 5, maybe 6 trades total. If you're going to get leveraged, right, you're going to use those other strategies, the bull call and the bear put diagonal. Those come with a little bit more risk. You find yourself maybe having to manage somewhere between 5 and 12, 13 positions, but it's worth it because those diagonal spreads, when they kick in, that leverage works in your benefit. So I hope that answers the question. There's no set number. You have to look at each position and you really have to manage your risk. You can't just say, I'm going to put 10% into each trade, because some trades may need you to put 10%. Some trades may need you to put more, some trades less. You have to analyze the risk of the individual trade.
Okay, great. And then this is an anonymous question and kind of ties in with another question from Steve. Do you recommend or suggest using Thinkorswim charts, and do you trade through those as well? Steve's question was, what stockbroker would you recommend or do most people use?
So my program is supposed to be brokerage agnostic, but you can't ignore Thinkorswim, right? Thinkorswim has all of options analysis. Tom Sosnoff really did us a service by putting together that software package. Tasty Trade is also, that's his new project, right? That's also a very good thing. But I've been around. I started using something, and I can't even recommend this tool because TradeStation, right? It's a fantastic tool, but easy language is, in my opinion, the biggest misnomer out there. There's nothing really easy about easy language unless you've got a background in Visual Basic. But whatever. Any tool works, and at Trading Trainer, we're actually developing a lot of the tools to substitute, because even with Thinkorswim, they just recently had to get some back end work because Charles Schwab took it over and finally brought it over from the TD Ameritrade servers. And there's some bugs in their historical option lookup tool now. When you go to a certain date and you look up some option prices and you think you're looking up the option prices on the date, it's not the right option prices, right? So, the idea is that you're not tool specific, but Thinkorswim's a pretty good tool, and a lot of I would say probably close to 40 to 45% of my users are using Thinkorswim. And when I do a demonstration like I was today, I use Thinkorswim because a lot of people are familiar with it. But in my own trading, I use some old archaic tools just because I'm an old dude who's stuck and learned these things back in the day. But man, I wouldn't recommend the quagmire that I use. I would use some of the newer tools and things like Thinkorswim as well.
Yeah, very cool. Jeremy asked if there's a move down in the underlying. Does it make more sense to own the leap or the stock?
I mean, so the leap is going to go under. That's when you get that worst case scenario. But here's the scoop. If you've got your protective option in place or you've got your bailout in place, it really doesn't matter. If you calculate out, where do I place that stop? Where do I place that protective option? Again, I'll show you on my screen. When we're filling out the configuration, you can see right here, it's at what price. You get to choose what price you're going to set your bailout order and what the strike price of your protective options are. And so long as you calculate the risk associated with that and you keep that in with the risk that you're willing to risk on the trade, you size your position. That's what it's all about. It's about managing risk. And so it doesn't really matter so long as you've calculated the correct position size for each strategy, whether you're using the leap or the actual stock. The nice thing about the leap is that when it does pay out in the rewards, it tends to pay out at a higher rate than using the covered put. So I personally, if there's liquidity on those back month deep in the money options, I'll always sway towards doing the diagonal over doing the covered call and the covered put. But you don't always find that. And sometimes, like for that Pan American Silver, I had to do the stock, right? Because the back month options just didn't have enough people trading on it to make it if I got stopped out, I wouldn't be I'd put my order out there and I'd be like, oh crap, the proverbial poop is hitting the fan. And I'd put the order out there and it wouldn't get filled because there was nobody else to do the trading with. So you got to factor all of these little things in to those type of choices. But the answer is if you have your protective option, if you have your stop loss, your bailout orders in place, I mean, that's how we hedge risk. Good question.
Yeah, great question. Yeah, Jeremy said thank you very much. Getting a lot of thanks. John said thanks. Just a couple final questions. Russ is wondering if there are any other indicators that you suggest or that you like to use.
Well, I mean, again, I don't want to give Jeff a big head here, but he came and he presented to our users his indicators, right? His reversal indicators.
Yeah, the
And
trade friend indicator.
not only did a lot of my users like go, wow, right? But a lot of my coaches went and they're now part of the Altos trading family. So, start there. I'm a big fan of the fast MACD. So you go and you look at the the Appel father son team. Marvin is the one. Gerald is the original guy, but Marvin came up with a MACD setting of using the 619.3. So I like using the fast MACD, but here's what I do. I first create my trade plan, my position sizing. I always go for risk management first. So the other thing you get when you define what the worst case scenario is and you decide on the position size based on what the worst amount of risk is, you also get the definition of this is what would create the worst case scenario. And so you can get price targets that help you if you can beat these price targets when you do your trades, right? If you take a look, and I hate to be, I know some of you are hanging on here. Let me just pull up that trade planning tool again. So take a look at one of these sample trade plans. It tells you, use your indicator. It tells you what you're going to do when you get your indication, how many shares of what, and then you'll notice it gives you a price target. So if I make sure when I do this covered put that I'm shorting this ticker symbol for more than $5.52. And then on the next step, when I'm actually selling the premium, I make sure I get more than 12 cents. If I make sure I hit or beat those price targets, there's no way I can get the worst case scenario, right? Because the worst case scenario is based on those price targets. We've defined what the worst case scenario is. And then as we do each part of the trade, we focus on beating the model, right? And so it becomes very strategic. And again, you can program these price targets into your conditional trades. You don't even have to be there during the trading session in order to see, you just say one of your rules is that don't get in this unless you're going to get more than $5.52 when you short this stock. So all to say, uh, in my process, I first create the trade plan, and then I go back and with a little bit of back testing, meaning I use the fact that I can determine through hindsight, I can compare when I get my indication versus when it actually reversed. I can then look at different indicators. I can look at Jeff's indicators. I can look at the fast MACD. I could look at a simple 3 and 5 day exponential moving average crossing and see which one has been consistently on this particular symbol hitting the top and bottom. I might use something exotic like an RSI or something like that as a validation. Once I've got that figured out, that will probably answer this question, right? And I find that every symbol might have a different indicator or different signal that would work best with its channel. And even, what you find with a lot of these symbols, like for instance, cat is a good symbol to trade premium on. I've been trading premium on cat since 2002, and it'll go through periods where all of a sudden it's trending. But if you look over it, like over the last 20 something years, cat for the most part goes sideways. Then every once in a while it'll get a pop up or down, but then it'll go for like a year, 2 years, 3 years sideways. And so you just keep cat on your watch list, right? And every time it starts to go into its sideways channel and it gets into a mature sideways channel that you can do one of these range bound option trading strategies against, you'll notice that back then a fast MACD was giving me my signals, and now I'm going to use the shaken oscillator as my end of day signal. So even the same ticker, and I think it's a psychology experiment. Different investors get involved with the symbol, and then it's a different, maybe it's a combination of volume and price action. Maybe it's so, but again, I'll tell you, Jeff's indicator has blown a lot of my program participants' minds, so I would start there.
You're too
What was
kind.
that? What was that one called?
I think you're referring to the trade trend indicator.
Yeah, I think that, yes, I
Yeah,
think
that was
that's
the
the
one
one.
I, yeah, demonstrated on your podcast.
Yeah, we're definitely way into you.
Well, you're too kind. All right, just two final questions. So Steve is wondering if the protective options are guaranteed to protect yourself.
The protective options are better at protecting yourself than stop loss orders because stop loss orders can sometimes be blown through, right? depending on how fast the drop or the pop is, depending on what strategy you are. Protective options are passive, right? How does the protective option, protect you? Instead of just liquidating your whole position into cash, which is what a stop loss order does, that's how a stop loss order protects you against a risky situation. The protective option kicks in at that strike price with in the money or intrinsic value so that it goes up dollar for dollar. It increases in value by the same rate that your other symbol is losing. So when you hit that strike price, yeah, the rest of your position is going to be losing value, but this is going to offset it. When you liquidate your protective option, you're going to, it becomes a net zero loss, right? Because one's going down, one's going up, but your overall portfolio stops. The passive option works passively. You can't blow through that strike price. It's going to accrue in the money value as soon as it becomes in the money, and it's going to then offset any loss from your other position. So you can't go wrong with a protective option. You should actually be a little bit more fearful of the stop loss orders, right? Because a lot of times stop loss orders can either be shot past. Remember, a stop loss order triggers at a price, but then the order has to fill. So if something goes right past that price, yeah, you might put a margin, a market or a limit order out there, but when does it fill? If things are going too quick, it might not get filled. It also depends on, what kind of the broker, there's a lot factored into liquidating a position. Whereas if you've got a protective option in place, it's always going to work.
Yeah, people are often surprised when I tell them I don't use stop loss orders, virtually never.
Yeah.
That's
It's
a
like a,
lot of the reason.
it's like a last ditch effort because you can't trust them.
Yeah, and there's just better alternatives. Like you mentioned, you can use options to mitigate risk, to hedge, to do all those things. And
And also just your analysis to begin with, right? You can, do everything you can to do an analysis and not even get into the trade until the probabilities are saying it's going to go your way, right?
right, exactly. All right, one final question. So you mentioned, well, and first of all, very generous to give the special discount for the Altos members, so they get using that promo code, they get the $100 off. The question is that for 6 months? And if so, after 6 months, what is the price
Oh,
of the program?
yeah, that's a great question. So, you're right. There are a lot of folks who, after the 6 months, realize that the trade reviews that we offer and the weekly workshops that we offer. I've asked people, in the beginning, about a decade ago, we would see people keep renewing and buying another 6 months. And so I finally was asking these people, why do you keep coming back? Am I not doing a good job in teaching you how to sell premium? They're like, no, it's fine. It's just that why would I stop doing it every Thursday? You give me another symbol and you even plan it out for me. And when you post the replay, you post the trade plan that you create during the workshop. Why would I stop that? And every time I do one on my own, I email it to you and you tell me what I'm missing. Why would I stop that? And I was like, oh, so we did create a lifetime access. I don't remember. I think that it's $19.99 if you want to have lifetime access, or if you just want to come back for another 6 months, you just sign up for another 6 months. And hopefully, if that's what you're doing, I think it comes out to $100 a month at $597. The $100 a month is worth it for you. A lot of people that are in it say it is worth it for getting those trades every week. Um, so yeah, you can definitely renew for another 6 months at the time, or you should look into our lifetime access. A lot of people have taken us up on that offer, and I think it pays for itself in like a year and a half or something like that. And then it's just freebie.
Excellent. Well, AJ, I want to thank you so much for taking time out of your evening to be here. Looks like we got a lot of thank yous and great comments. Thanks to all of you for taking time out of your evenings to learn more, and
Yeah.
really appreciate all the great information AJ provided tonight. So, and I think you have your contact info. Maybe throw that up one more time. So if anybody wants you to, Bill said morning, um, uh, contact you outside of after we sign off here. He's got the phone number. You
Just
guys can
call
give
me.
AJ a call. Yeah.
Yeah,
Very,
just
very
call
generous.
me.
That
I'm at extension 1. So if you get through the number and you press 1, and like I said, leave me a voicemail if I don't answer, but you'd be surprised. That number actually rings this here mobile phone. So I often answer when you wouldn't expect me to answer. So, just call that number. If you let it ring through, you'll get to our folks. My main office is based in Fort Collins, Colorado. So that's where the people answer the phone, and then it bounces to me if you press 1, or if you ask them to bounce it to me. So no worries.
very kind of you. Very kind. All right. Well, once again, thanks, AJ. Everybody, this was recorded. I know there were a few people that joined late or had to drop off early. If that's the case, well, in either case, even if you were on the whole time, we will be sending a recording out for you guys to catch anything that you might have missed or review. I know there was a lot of information thrown at you, so we will get that recording out to you guys. And in the meantime, hope you guys have a great rest of the trading week. Thanks again, AJ. Hope to see you soon.
Yeah, thank you. You will be seeing me soon because I'll be sitting in on your calls because my wife signed up for your program.
Oh, did you?
Yeah.
Oh, bless her heart. That's
All
great.
right.
All
Cool.
right. Well,
Take
thanks so
care,
much.
everybody. Bye.